I'm Keith McCullough, and welcome to The Pitch. So we have 10 analysts, 10 stock ideas in 60 minutes. And unlike the bozos you see on TV, our analysts actually have a process, models, the real deal here, right? And we're going to start with our heavy hitter, the guy who's been just absolutely slaying the perma bulls like his job, because it is his job, Brian McGough.
Thank you. Well, we don't have 10 tickers, we have 11, because I got two for you this morning.
We're going to do a twofer.
We've got a long and a short, and it's a pair trade. Long Capri CPRI, which I think looks good on your signal strength, and short Tapestry TPR. Okay. So just as background, these two companies are merging. TPR is buying Capri at $57 a share. That stock is trading now at 51. It should close over the course of a 3 to 4 month time period. This is in the Risk-Arb hands right now. You know how that game is played, but we have a secret weapon on our team. His name is Paul Glencher, who thinks there's a very high probability that this deal closes. I do too. I don't have the time to go through all the background behind it, but I absolutely think this deal will close and you get paid on the CPRI side. I think that's straightforward. Is it sexy? 12% over the course of a 4 month time period? In a retail tape where I think everything is going down, I think yes.
What's the takeout price again? CPRI?
$57.
Okay.
But I think where the real juice is on Tapestry on the short side. And there's a couple of reasons why. So this stock is now trading at 27. We shorted this at 34. I think it could go to 10. And the reason is that the leverage this company is taking on is insurmountable. So it has zero leverage right now, and it's gonna, on the day this deal closes, it's gonna be 4.2 times levered. What's happening right now, John Idle, who's the CEO of Capri, is not a good guy. That's that guy right up there on the screen. John, I hope you're watching, and I wish I could use a word to say what I really think about you. But he's the one who orchestrated this deal. He got this done. He's doing whatever he could do right now to prop numbers up and keep the Capri engine humming so this deal closes at the right price.
Guy looks like a bit of a rat.
He is such a rat. He cannot be trusted. But what's going to happen is so he's stuffing the channel right now. Oof. TPR is going to have to clean that up once they close this deal. They're also going to do the right thing. They're thinking 10 years out as far as this deal as a transformational merger. So they're going to pull back dramatically on wholesale distribution for the Michael Kors brand. Punchline is EBITDA is coming down. So EBITDA coming down, debt burden going up, closes at 4.2 times leverage. You're going to see leverage push 5 times. We've seen these names trade at 5 times EBITDA. You did the math. 5 times EBITDA, 5 times leverage. What does that get you for equity value? 0. Am I calling this a 0? No, I'm not. But at some point, I'm going to stand here, probably the pitch in another 13 weeks and maybe 26 weeks. And I'll be here with the stock at $10 saying it's a great multi-bagger over a longer time period, which I think it will be.
I like it.
But at a much, much lower price. So the bulls, the perma bulls, who are calling this cheap on earnings right now, aren't looking at the balance sheet and they're going to get hurt.
There you go. 6 minutes. Inside of 6 minutes, he said he'd do 5. He did. That's the first one. We're going to go to Tom next. TPR, by the way, I'll tell you what the signal is. TPR is bearish trade and trend, and you get, actually, CPRI is right at the low end of my range today, so you'd be buying that. Tom, welcome back to the pitch.
Thanks. So it's Radnet, RDNT. It's been on my short side for a bit. It's down about 25% or so. I think it's got, a nice fat drop from here. So you start with sort of the healthcare macro on diagnostic radiology, and so what's been going on here, I think, has been just a less efficient box, broadly speaking, across diagnostic radiology. And what you see on the healthcare macro chart is essentially aggregate hours worked is essentially flat to slightly down, but hiring is way up. So it's just a less productive box, and as you're also seeing some wage inflation broadly. So if you look at Radnet specifically on the next slide, cell phone data says things are slowing in Q3. They've had a couple of good quarters first half. They've had a nice recovery post-pandemic. It's part of this whole pent-up demand, et cetera, except that first half, increase of 6, 7, 8%, essentially looks like, actually, I'm sorry, on the next slide you can see that cell phone data looks a lot like the same store growth, same center growth And then the next slide, this is the key one, diagnostic radiologists, they've been hiring really well. So they're expanding the group, a lot more reading diagnostic radiologists. That's up about 8% through that first half and about 7-8% through third quarter. And what that means is if you look at the same center volume forecast for Q3 is around 2.7%, deduct the 7% for the doc ads, you get to a negative per doc count. So I think what that's going to present for them is, yeah, maybe they're going to hit the quarter, but if they hit the quarter, they're going to have a lot of productivity issues, they're going to have some margin issues in the shorter term. There's a bull case on this thing with Leqembi, which is a disease-modifying Alzheimer's drug. They have to do an MRI for these patients on the front end, on the back end. That's a very essentially expensive, high-value scan for them. But it's really small numbers right now, and I think it's mainly going to happen in academic research centers and not in a freestanding center like Radnet. The other piece here is on a recessionary piece on slide 13. Essentially that high-end consumer is weakening in terms of their forecasted medical spending. That's all been flattening out after accelerating post-pandemic. Most of the volume in this kind of space is insured. Insured means that you're higher income, and if this is a higher income recession, it's going to be more closely felt by somebody like Radnet. And then the last thing is the quad factor score lines up. So that's been deteriorating. What it has in its favor is a lower EV to sales, which scores well in quad 3. But if you get just a minor change in the estimate revision trend, this thing is going to be toast. So it's sort of a high single-digit, low double-digit EBITDA multiple. 256 for next year. I think 256 could be 220, 230, up slightly year over year. They also have an AI piece, which I think is made up. So GE Healthcare announced yesterday.
Somebody making stuff up about AI?
No, it's more like they're investing to build their own AI tool.
Yep.
But there's hundreds of these products out there, and they're losing money on it, and they're trying to get the consumer to pay this premium for the this extra special read, which is probably valuable. But at the end of the day, this is going to come resident on boxes that GE builds or Philips builds or Siemens builds. They're not going to have any sort of market advantage for very long. That's it.
Good. This thing's bearish trade and trend. That's good. So that's what we want in shorts. Bearish trade and trend with low short interest, actually. 4% short interest means that the bears haven't all quite figured it out yet. So I like that. On the short side, I like the shorts. I think Biolsi's next. Biolsi better give me a short because his group sucks. Thanks, Tom. I said that to you this morning. Your group. I didn't mean you suck. I said that the group sucks.
I didn't take it personal.
Everyone knows I suck from time to time, and
you almost made me give it away too. So I'm bringing Bud.
You're bringing it back.
I'm bringing it back. So I thought you were going to make me give it away, but I try to keep it.
So we're going to, on the big bounce we had yesterday, you get the short Budweiser again.
Yes, that's what I'm here to pitch. So what stands out here on my first slide, 17, is just how global Anheuser-Busch InBev is. The U.S. is not the largest, and it has become smaller. Last year, North America was 30% of the EBITDA. Now it's 24%. The currency-wise, because the U.S. isn't that large, the company enjoys a weaker dollar, right? So the stronger dollar is a headwind. You can see the basket of currencies here on slide 18. And just to give you just a broad, quick picture of the beer industry right now in the U.S. on slide 19. Domestic beer itself is seeing volumes contract, and this is because disinflationary trends are trailing the rest of food and beverage. Like they're a little bit late to the price raising game, so you're seeing a little bit more elasticity impact now. So not a healthy industry right now for volumes, which is what the focus currently is for this space. On our next slide, so everything really sort of hit the fan for Anheuser-Busch InBev when Bud Light had a sort of marketing mishap on slide 20. Basically the company had did a 180 after years of courting, decades of courting the football fans, with frat humor, horses, talking animals, and just the country, right? The countryside. They just went 180 degrees and did a marketing tie-in with Dylan Mulvaney. I mean, anybody who takes one semester of marketing class knows you just don't do that, and that's where all this the new recent problems started for the company. And of course, there was this immediate backlash on slide 21. I think this is sort of unprecedented. That's why they're probably going to teach it in all the business schools after this. The backlash was really unprecedented, and the immediate reaction was what I would, very strong in what I would call an anti-Gandalf. So the Gandalf thesis that I've used in the past for various sort of problems that companies had is like, we're Gandalfs in Lord of the Rings and say, you shall not pass. Well, there's the anti-Gandalf thesis is like, this too shall pass. Most big problems seem to pass. You get easy comparisons. But I think this is the anti-Gandalf thesis here. On slide 22, you can see from this recent market share losses, they've just sort of been very entrenched. They really haven't moved a needle, and this is despite significant resources being redirected from marketing dollars from abroad to the U.S. So despite the passage of time and all the effort, all the executive effort, all on one brand, they've moved marketing spend from the UK, from Latin America to the US, and it just hasn't moved the needle, which I think is concerning. On the next slide, so the next step here was the slide, I can't say it. So the next step here is the spring shelf resets. That's typically a much bigger reset for the beer industry. So Bud has to act really fast, otherwise the market share losses become self-reinforcing. Marketing as well is set as a percentage of sales. So you can see they have to act quick, otherwise this is just going to be cemented. So management said the fall resets have been very small. They said they quantified it at about 5% of retail shelf space. And Molson Coors, in comparison though, this matters because they're one of the biggest winners here in the shelf space, is that they're gaining significant amounts of shelf space at dozens of major US retailers as they reset for the fall. And they've already gained thousands of tap handles here in the US. So yesterday the company did not mention what the tap handles were. They just mentioned that Bud Light has lost 5% of the shelf space. And the bigger ones are going to be in the spring. And what Anheuser-Busch is trying to do now is they're dangling $150 million in incentives, trying to pay anything to keep this in, extending financial credit. They have to, and that's going to have an impact on the rest of their businesses. They have to concentrate so much on their problem child right now. And then you have the quads. Of course, no surprise, Bud hates Quad 3. That shouldn't be a surprise to anyone. Maybe Keith can go through exactly why, but I hope I've done that. And then valuation perspective, it's been lower in the past, and I think earnings estimates are going lower. And then of course the space. The reason why Keith says he hates my space is valuations are going lower in my space.
Well, in Quad 3, where you have stagflation, you want to be short consumer staples. It's bearish trade and trend on the signal. It just bounced to the top end of the range. It has less than 1% short interest. It's nuts. I mean, I actually did a little experiment last night at Halloween because I always have a bar outside my house.
Okay.
So I got the cooler with the beers.
Yep.
I put 6 Bud Lights in there because I have some old inventory. I'll secretly drink it because I actually like the taste. And not one of those beers was gone.
Oh,
not one.
That's interesting. I went to a Jets and Giants game with some people I didn't know on this Sunday, and I just said, next pitcher Bud Light, and people yelled at me.
Really?
Yeah, they yelled at me.
It's like, man, it's peer pressure.
Yeah.
But it's a good short.
Yeah.
All right. Thank you. Appreciate it. Look at this. We get the double. We get the doubling down on our hottest team on the short side. You guys, I thought we had you guys are giving me 2 analysts on the same team. Yeah.
Yeah.
Well,
more retail.
You've been hot on this show, so I know everyone's waiting for your.
I have been hot, and I'm getting cocky here. I'm doing a company that's reporting tomorrow.
Oh boy, this is getting a little, when you got 21 straight book gains and real-time alerts in a row, you get a little cocky, but It's okay. You ever see a uncocky baseball player in the World Series looking totally unsure of themselves when they're on a roll? No, that's not the way the game's played. When you're hot, you're hot. All right, go.
So yeah, we got another one here. We think makes a lot of sense short side. So the ticker is Arhaus, ARHS.
Ooh.
If you don't know Arhaus, it's a high-end furniture retailer, right? You can Google it, check it out. Kind of competes with RH in aesthetic, but not in terms of the overall product offering, product quality, and customer service. But the key pieces of thesis here. So the first slide, existing home sales are still down mid-teens, right? So we're seeing existing home sales down a lot significantly reduced numbers last year. We were down 20 something last year. Now we're down mid-teens on top of that. And the point there is that there's studies that say, right, when you buy a house, you do more around investment, whether it be appliances, furniture, home improvement projects. This actually plays into a reason on why we're still very bearish on the home improvement landscape. But home retail and aggregate, I think the demand dynamics matter in terms of reduced home turnover. So we look at the traffic trends at Arhaus on the next slide, kind of confirms the demand dynamics we were just talking about, right? You're seeing the run rate here down, call it maybe mid-20s in recent weeks and slowing. And you have to keep in mind, this is total visits year over year. It's not comp visits. And the store count's actually up year over year. I think it's up like 6%. This is a sample of about half the store base, so it technically doesn't include all, but it's a very good representative sample. And that's not a good trend by any means in terms of what the visits look like. Now on the next slide, kind of ties in, it's actually much more important to look at this. So this is the backlog dynamic. So we don't know if people appreciate what's kind of happened here in the home landscape, where you had such big demand during the pandemic. So you look at those green bars here on this slide in 2020, 21, the demand was exceeding what the company could meet from a supply chain perspective. So the demand is essentially their orders, the comps, what you actually ship. And then what you've had happen over the last year and a half is the company satisfying that backlog. So they're starting to ship more product than what is actually being ordered. Hence, you have more revenue than what your actual comp or your actual demand trend is. So now what we have is a real problem when you lap all that backlog satisfaction, right? It's basically excess revenue that happened last year that doesn't happen again, and that puts a lot of comp pressure and margin deleverage risk throughout the P&L. So we've kind of built out what we think those demand trends here look like over the next few quarters, what the comp impact is, and what therefore from the backlog, I should say, and therefore what's the underlying comp trend. So on the next slide here, which is slide 31, we put what is the sort of comp risk. We're not modeling exactly down mid-30s. I think we're down closer to 20 in the next couple of quarters, but. Right, like that's the sort of headwind on the next quarter here. That's a zero demand, I'm assuming, not even down demand with what the visits trends look like, and that where the street is from a comp perspective. So punchline is that we think there's a lot of risk around what the comp numbers flow through like over the next 3-4 quarters, and the underlying end demand we think is not going to be as good as the market's expecting right now either. So that means basically numbers need to come down from a revenue perspective. And the margins are going to compress at the same time, right? The company could drive better revenue by discounting, doing some promotions. We've seen that in like the last quarter. Their demand went actually up, but their margins now are coming down. So if we look at how that plays out into our numbers on the next slide, we think there's upwards of 35-40% downside in where the forward earnings expectations are, and we're giving that like a low double-digit multiple now. You could say maybe that's too high. It is a unit growth story, so that's kind of where they trend on the lower end. We could give it something higher when the earnings are going up, but when the earnings are going down, we think something around 11 times is a reasonable level. That would give you 30% downside from the current levels on the stock. So there's a little bit like better e-commerce trends and the visits trends, but those visits trends look really ugly given the risk around the backlog, and we think this makes a lot of sense on the short side right here.
This stock's looked right on the screws too, by the way, for a guy who used to hit golf balls professionally right on the screws. This stock's, it's not been in a long history, right? I mean, it's public since it looks like
pandemic IPO there.
But it's gone from 13 to 5 before. And here we go again. It's got higher short interest, about 8%. It's still bearish trade and trend. I mean, it looks like you could get to $7 tomorrow, which is basically what you're saying. I mean, you're seeing, and some of these small caps. So small caps, for those of you that don't know about the bear market, just look at small caps. It's got $1.2 billion in cap. Small caps lose half their market cap in a day, a couple days of missing numbers. Look at Paycom. It's going to be a small cap now. But I mean, this thing, people underestimate how fast small cap has no liquidity. So if you have to sell, you have to sell. Have all the bulls that you guys have talked to been kind of like talked to about this, or do people talk back like no way?
I mean, so let's say I think there was a sell side reiteration of their position at with a price target of $15. So I think people are too focused on the unit growth opportunity and not how bad the margins and comp trends can get over the near term. And they're probably putting too big of a multiple on that, given the earnings risk and the general, I think, multiple risk across retail that we're seeing with higher rates, right? Like the sort of previous cycle multiples are probably not like where these things should be, right? You shouldn't be putting 20 times on Arhaus because it's going to grow units over the next 3 to 5 years if the earnings are going down by 40%.
Yeah. I mean, when I started in this business going into the 2001-2002 recession, stocks would trade at 4 to 6 times cash flow. Never mind, those kinds of multiples that you're talking about. So, lots of downside. Good short. All right. Thank you. Bearish trade and trend. That one is. Now here comes the guy who brought you MPW. If you give us another one of those, I might just hug you.
I'm working on one.
I don't know if you'll ever be able to find one that's that bad.
I will. Realistically.
So bad.
Realistically, like that's a once. You have to be realistic about it and ground yourself and like wield that sword judiciously, and not.
I hear you.
Be responsible, So, but I am working on an interesting one. But so we're going from the guy who like hit golf balls professionally to the guy who hit stingers to the front tees. And the course record's always safe. So anyway,
give me a long in real estate. I bet you it looks like that kind of a ball.
Jesus, I mean, it's brutal out there, man. I mean, and it's tough because clients are just like they're looking for longs, and every meeting it's just like, listen, what do you want me to do? What do you want me to say?
But don't worry, all you out there that are watching, we're watching CNBC. Yeah, the economic data is so bad today, so fucking bad, that bond yields are going to go down. Like a recession is going to make real estate go up. That's what the trade is today.
Yeah,
kidding.
Well, anyway, so yeah, right. It's banana land in my space. But so Iron Mountain.
Ooh, short.
Yeah, it's a short. So, I mean, like, I can't come in here and pitch a long. I gotta pitch after that. But so Iron Mountain's a really interesting one. Like, very quietly was the best performing REIT stock over the last 2 years. For what had been a dog for a really long time, kind of like, everyone in the corporate world has seen them send the trucks out to your office. They pick up, boxes of paper and physical records, store them in their in their facilities, which is the real estate. But really, the real estate is the racks. So, like, they charge their customers rent for stored materials, and then like their fees for service for shredding and all this other stuff. And for the longest time, it was kind of like a 2 to 3 compounder, like melting ice cube type business as things shift from physical to digital storage. And by the way, they're kind of cannibalizing themselves in a way by developing data center. But long and the short of it is they kind of figured out along the way about 4 or 5 years ago that they have this really sticky customer. So think like the Fortune 500, big corporate that can't really use anyone else with a very high retention rate. And they stuck those guys with like very high price increases. So you had like just, on a weighted average basis, you had what was a 2 to 3% compounder step up to something close to a 10. But what's interesting, and then so now we love this at Hedgeye, we're starting to lap those base effects. I mean, like, look at that chart, right? You're into the teeth of revenue comps. Like, that is a really scary, yeah, right? Like,
it looks just like the stock chart.
Right.
So by the way, for those of you that don't know what a long looks like, before revenues do that,
yes.
or anything does that in a P&L, you want to be long. And as much as on the other side, you want to be short. We're not evil doers here.
No,
this is just math.
Not at all. Yeah, it's an uncomparable comp, to use someone else's phrase, right? So, but what's interesting from an analyst perspective is that while they're hitting these large customers, these large corporates with price increases, their retention rates overall are going down. So like my interpretation of that is there's lots of churn heading into a weaker macro amongst the smaller customers, right? So like not only do you have to comp the comp on the larger guys, but how do you pass along the same price increases to the smaller guys that are more likely to move out anyway, right? So like it's a really high hill to climb. Okay, next slide. Without getting too technical, this is actually my interpretation. It's a little hard to do because their disclosures like kind of wonky in some ways, but that blue line on the left side is just a representation of their organic growth trend in their storage business, right? So like that from a macro, like from a Hedgeye perspective, right? The left-hand chart is like really scary to be long. it gets like, it's kind of sets itself up as a natural short. Next slide. Yeah, next slide, guys, sorry. Okay, so now the short-term catalyst is the rate of change, right? So just start right there. The long-term catalyst is something that's really interesting about this company. My theory is, and I think this bears it out, this is just a simple cash flow, like retained cash flow chart, and it's down and to the right secularly over more than a decade. My thought is the worst thing this company ever did was convert to a REIT. So they lease 3 times more facilities than they own. which means that they have less DNA in their P&L than they otherwise would within a REIT wrapper. So like less DNA, higher taxable income, it forces them to distribute more than they otherwise would like to.
They would, yeah.
So like it's kind of this situation where they can't retain as much capital as they would like to, and they're going deeper into data center, which is more capital intensive. And oh, by the way, despite being the best performing REIT stock over the last 2 years, they haven't issued any equity since the first quarter of 18.
Ooh.
So like it's purely levered borrowing, negative cash flow, no equitizing the balance sheet. It just doesn't make any sense, right? So like that's kind of a nasty combo in the REIT world where you're putting yourself into a box and it sneaks up on you really quick. That's the longer term challenge. The near term challenge is the rate of change, which may catalyze the long term challenge. So anyway, that's
Very
it.
good.
It's an interesting one.
This one, I mean, as our partner Jay Van Sciver likes to say, Wall Street's in the business of selling you stock. So this guy Bill Meaney sells it like it is his job. I was going to say the CEO sells stock like it's his job. I mean, he's been selling a pile, and they just sold a bunch in September and October. Was that on a plan, or is that just?
I have to check. I don't want to speak out of turn. Let me double check.
So I mean,
I think so, but let me. Yeah.
Like when I look at things, we look at all the factors, right? The short interest on this is still shockingly low, 4%. Like you said, if you look back,
it was 8, by the way.
Yeah.
A year and a half ago.
And now it's come down, and the
yeah.
stock had gone up. It's now bearish trade and trend, but this could easily get back into the low 40s on my signal. Is this? They haven't reported the quarter yet.
Not yet, no. So that's upcoming.
Is that like an imminent? I guess it's an imminent catalyst for the top line.
It's an imminent catalyst, but really the way I'm thinking about this is like the next 2 quarters we're going to find out if they comp the comp. And it's just a really low probability that they do it. I wouldn't necessarily play it on this quarter, but we're going to know. Like by the end of the 4th quarter.
Well, what's been happening in earnings season for all these yo-yos who think that the markets trade on yesterday? I mean, they're like, okay, we had a great quarter, guys, but then if anyone who guides to anything that's squishy, is this company in the business of guidance, by the way?
They are, but with 4th quarter earnings, so we're going to get that the next quarter, not this upcoming week.
Okay.
So, well, I mean, like they may hint to it, but what they've already told us is that whereas they had been a 10% revenue grower over the last 2 years, they're going to permanently reset to 5. They told us that. Like, that's enough to me is like to re-rate the stock lower as it re-rated higher on the acceleration, right? But they're telling us that it's going to decelerate.
Last question on this. Like, is there anything about this management team that bothers you, or are they like straight and narrow? Because you have a very good bullshit factor in your model.
I think, yeah. Well, so there's, like I said, wonky stuff in the reporting. So they, I think they're trying to do the best with what they have.
Yeah.
So I want to give them the benefit of the doubt, but like they reorganize their business segments a lot. They book restructuring charges every quarter, and sometimes when you measure the quote-unquote restructuring that are literally every quarter, that bridges the gap between reported and the beat.
Yeah.
Or like it accounts for the beat, So I don't want to make any accusations there. That's just a fact. That's what they do. And so it's weird, like funky little things. So I'm kind of sniffing something out, but like not 100% sure.
Barry, it looks like his name
Barry
is
Heitman. Yeah, no, he's done a good job, by the way. He I want to be fair. Like he took what was messy and made it less messy.
Okay.
But it's interesting.
Yeah, sometimes, as the great Moshe Silver said once at Hedgeye, the only retired partner, it's easier to make a mess than to clean it up. All right.
It's still weird.
All right, thank you.
All right.
He is the one and only REIT Rob. I think we're going to go to the Zoom now. We're going to go to my man, Nick Balch. Easily, at least you shaved. Look at REIT Rob. He's like, he doesn't sleep. He has to deal with these MPW guys and their non-disclosures, so he can't sleep. It's a tough life when you're like, in the middle of stuff like that. But you look fresh.
Have kids.
Oh yeah. By the way, Nick Balch is still single, from what I understand. You don't have to disclose otherwise if there is a disclosure to be made. And what do you got?
So today I'm going to pitch a cannabis company, actually. Oh yeah, cannabis company. I think it's the first one on the pitch, so I'm excited about it. Okay. But they're a single state operator out of Southern California. Just a little history. The company did $91 million in revenue in 2022, which was up 31% year over year. And that's all while wholesale prices in the state were down 30%. So a little bit about the company. The company does have 10 dispensaries, but this is very much a cultivation story. They're all about the wholesale business. It now makes up 70% of their revenue. And by the end of 2024, we believe it's going to make up 80% of the revenue. And I get it. going along a farming company is far from sexy, but cannabis is a bit different because there's so many steps involved from
So they wholesale, just so people know, wholesale, they sell pot, like they grow pot and sell pot.
Yep, exactly. They cultivate it and then they sell it to different brands, and then they're able to package it to the dispensary. But they do have dispensaries, but that's not really part of they're more about the farming side, which, you know, I get most people don't like to go long farmers, but cannabis is it's very complex. There's so many steps in between that seedling phase and when you can actually produce it, which creates this great moat that Glasshouse Brands has around them in California. And you know, since we've gone long the stock in September of 2022, the stock is up 65%, while the MSOS was down 25%. So significant outperformance. And now let's kind of get into the investment thesis here. So it really boils down to three main parts. One, Glasshouse is the lowest cost producer, and they have more scale than any other cultivator in the United States. Number two, the California market has been an absolute shit show the last couple of years. And while that was happening, Glasshouse Brands was still able to take significant market share. And now we're starting to see an inversion in the trajectory of that state. And number three, we're seeing positive commentary around interstate commerce. We're not going to say it's going to happen, but that's more for the tail duration. And if interstate commerce were to happen, this is at least $100 stock from here. So let's kind of explain what's going on in California, because that's a very important part of this thesis. If we go to the next slide here, California is by far the largest company. The next slide, guys, or the largest state within the cannabis space. And when we look at active licenses in the state, it really peaked out in 4Q of 21, and not so surprisingly, wholesale prices bottomed about a quarter later at $188 a pound. And so that low price made it absolutely impossible for cultivators to survive in the state. And because of that, cultivation came down. Glasshouse was able to expand their cultivation, all while taking market share. And now prices, now that there's so much cultivation came offline, prices have now come back to where in 1Q and 2Q of 23, the industry saw prices at $290 and $340 respectively. And now if we go to the next slide here, we kind of have pounds of biomass produced by Glasshouse Brands. And so they moved into a new facility in 2022. So 2023 will be their first full year within that facility. And in 2024, the back half of the year, they're going to open up Greenhouse 5, which will bring an additional 1.5 million square feet of cultivation space and will contribute 250,000 pounds of biomass, which is huge for it. And the next slide, this is why they were able to thrive in California's low cost environment for so long, was due to the fact that they're the lowest cost producer in the state and in the country. They currently run at $139 a pound. We'll get to $120 a pound in the back half of this year. And we believe by the end of 2024, it'll be $100 a pound for their cost of pounds produced. The next slide just shows prices per pound. We'll skip over that. And this leads us to the top line growth. So in our model, we're being very conservative in saying that prices will stay steady. We believe they're actually going to go up, or we're going to say they're going to stay steady. And the driver of the business will be this added capacity of their greenhouses. And so we're seeing 97% top line growth in 2023 and drastic growth in 2024, and they have more room to bring on more capacity in future years if they need that space. The next slide, we have margins. They're in the middle of the pack, but we'll get to the top regime of margins within the industry by when that greenhouse turns on. And so really how I'm looking at this, over the trade duration, they have significant upside in the back half of the year because cannabis is very seasonal. And so we're going to see huge growth in the back half of the year. And they've had optimization over the trend duration. Them opening up Greenhouse 5 will also lower their cost of production and increase top line. And over the tail duration, you have interstate commerce as a huge benefit to them.
Good, real good. This is not a well-known story. Again, long piles of pot. And that's like, I'm not a pot guy. I don't smoke pot. Full disclosure from me too. But that's good. We got to keep going here. Thank you, the Nick Balch, on his first on the pitch. You're no stranger to the pitch. People love you, man.
Oh, it's good to hear. It's good to hear.
I love you, man.
Hey, there we go. Let's do it. All right, so I got a short.
You got the teledoc on today.
No,
huh?
I got this for free.
Oh, okay.
At the investor day when I was working with Tobin.
Look at that stock. Huh?
That was the top.
Look at that stock. Remember there was
Patagonia.
Remember Kathy loved teledoc. I mean, it's like, hey, great for the long term. Just don't forget all the things that you've been totally screwed by Wall Street with TDOC is the ticker on that. Look at that chart. What a chart that is. Anyway.
All right, well, I got a short for you.
Oh, you do?
There we go.
Okay.
So we're going to pitch Charter Communications, ticker CHTR, as a tail short. From a process perspective, it checks the boxes on multiple fronts in terms of being a structural short or tail short. First, the company is facing a saturated market with home broadband and internet penetration rates well over 90%. Second, increased competition, on the margin from fiber and fixed wireless, where fiber is a marginally superior technology, which we'll get into that in a couple slides here. And then third, capital misallocation. So you have declining penetration rates in the core markets being partially offset by these very expensive rural investments, these rural build-outs. Charter is investing in these rural build-outs because guess what? There's nowhere else for them to go. So to my first and second points here of being fully saturated and facing increased competition, this is resulting in higher levels of CapEx, declining free cash flow. Meanwhile, the company and management team continues to be adamant about repurchasing their shares at 4.5 times leverage when I think they should actually be deleveraging. So ultimately, we struggle to see how the company can grow EBITDA, see risk of EBITDA declines in the long term, given a saturated market, increased competition, also negatively impacting pricing power. On slide homes passed by technology type, you can kind of get a sense of it's just a different world. Competition, home internet has arrived. These used to be monopoly markets for the most part, but now with the rise of fixed wireless and fiber, the replacement of the old DSL technology, the old copper lines that no longer exist. I actually remember dial-up internet. So I'm still young, but I was there. And so you can see that the world has just completely changed in terms of the number of internet options available to the consumer. Meanwhile, DSL, which is the technology that cable feasted off of from the telecom companies for a decade plus, you could see is no longer on the next slide on DSL facing increased competition, just is no longer available in many of these core markets. I think what's really important here too, because pushback is that telecom, these investments in fiber is simply not sustainable. We could debate that and what the definition of not sustainable is, but there is value in the infrastructure, and you can see in terms of the current and future state, our viewpoint here is that consolidation is inevitable on the next slide. So that even if, Consolidated Communications just got taken out, if Frontier stops building for whatever reason, which is not our base case, that they will be acquired by somebody else, and therefore with somebody else that has scale that can afford to invest in these further build-outs and continue to invest in marketing and drive higher penetration rates. So either way, when we game theory out the industry, it's really it's a tough slog. There's not very many paths to success here if you're a charter. Here. And then on the survey, we're kind of informing our view, and this can change, we'll update this, but we did a fairly comprehensive survey in December of last year, and you can see that, just given the option between fiber and cable, the technology types, and keeping the monthly price equal, network speed down and up equal, that the consumer is going to choose fiber over cable 68% of the time, where cable penetration rates are currently well over 50%. In the very long term, that doesn't bode well in terms of the rate of subscriber trends for a highly levered business. So on a valuation basis, which is last, we just provide a discounted free cash flow, which these assumptions I can tweak them each way, any way you want. But ultimately, we get a stock that's much, much lower here if we're right directionally in terms of the CapEx trajectory, free cash flow trajectory, subscriber trajectory, and if more importantly we're right on the capital misallocation piece. I think there will be a kind of come to Jesus moment, as they say, where expectations reset. So I'll leave it at that.
And you're talking to a Catholic guy.
Hopefully I didn't offend you.
No,
You're not easily offended.
As long as you're pitching me a short, I'm not offended by anything.
I can pitch you along and really offend you.
It still has $60 billion in cap, equity market cap. It's very well banked. 9% short interest. It is bearish trading trend. I mean, it wasn't too long ago that this, which is at $405 a share, that was at $300.
Yep.
I mean, I'm assuming that's like the first stop. No.
You tell me. I mean, it's on your levels. I mean, yeah. I mean, I think this thing could. Look, they just had a pretty tough quarter this last quarter. They're having trouble on the internet pricing side. They guided to a weak Q4 in terms of broadband subscriber trends. I think there's, without getting into too many of the details, Comcast also had a weak quarter, so the industry dynamics are taking hold here.
Good. All right, we got to stop there, and I'm gonna add to that. I'm going to short CNBC right here too.
There we go.
There you go. That's very serious, okay? A very serious position. We need a ticker for that. That'd be a great ticker. They should spin that out. I would short that with impunity. All right, let's go to the Zoom. Jay, looking good,
Hey,
man.
Keith.
I like it. I like it. You don't have the stash. You got the beard. We got some guys on the team. I wasn't going to say gals. Guys on the team that have some significant stash going on, but you've stayed with the beard. Good.
I just stopped shaving. It's not so intentional, and we do have a long for you today, but there are a couple things that'll be okay about it. I think one is it's Huntington Ingalls,
Ooh, defense stock.
Specifically for a couple of my colleagues. Defense contractor. It shows up on your signal strengths, which I think is very reasonable. And the defense recapitalization story is, I think, a good one. If we look at the aging of assets, a lot of the defense hardware and investment that occurred during the war on terror, or whatever, was not the big platform assets like ships or new fighters or things along those lines. They tended to be more consumables. So we have a recapitalization underway as this old fleet gets replaced. We're also, as one may have heard, in the fourth turning, which seems to be more and more prophetic as we go through increasing geopolitical tensions. So we do have this feedback loop where you see defense spending increase in one. If South Korea increases defense spending in response to China, Japan's going to increase defense spending. You get this kind of feedback loop in spending that we're already seeing. And I think this is one that surprises people looking at the size of fleets, that the U.S. actually doesn't have the largest Navy by number of boats. It's in fact China, and we're roughly the same size as Russia as well. And then, these are obviously not all the same ship, and we can go through, those issues. But this is a situation where oftentimes the size of a naval fleet has a lot to do with who wins in a naval battle. And this is, a potential political liability as we go through, into another presidential election cycle. And when we look at sort of the dynamics of our own, fleet size in the U.S., so that's the number of ships. So we end up being third by number of ships. But on the next slide, you'll see that the U.S. Fleet size has contracted really for quite a while. And that's finally inflecting. You want to go back one slide. There you go. And what you can see there, the blue line, is that China is caught up and is actually increasing the size of their fleet quite significantly. So that's a potential issue and a political issue like the missile gap. It's also just like a projection of power issue. So I don't think there's much reason to think that we won't have increased investment in the Navy. You have an old fleet. You have you have no longer this unipolar world. You have geopolitical rivals that you need to dissuade from, being, in combat with you or whatever, however you want to phrase it. The next part, though, I think is sort of the interesting one, which is this creation of a ghost fleet, an autonomous fleet on the slide here. So one of the ways that the Navy plans to close that gap is to add a lot of autonomous ships. So we're going to create an entirely new, basically, kind of fleet within the existing fleet. That's a significant growth investment for a company like Huntington Ingalls. And when we look at at sort of the valuation and who owns the stock, right? It has that blue line on the right is growth investors. So even though you're about to have the creation of an entirely new fleet of ships, there is in fact very little in the way of growth investors there. And relative to other defense companies, Huntington Ingalls, which is spelled auto-corrected incorrectly there, sorry, the valuation is improving. I think it bottomed out and will start to increase. So from our perspective, we have this geopolitical, hotbed. We have a fleet that's been shrinking, about to go through both a refresh and an expansion in terms of its, a new fleet of this sort of autonomous ghost fleet, and it's trading at a steep discount to a lot of its peers. So I think HII is a good place to hide in Quad 4. It's a small Quad 4 outperformer without macro sensitivity.
Perfect. Just pristine timing. And I just tweeted Jay Van Sciver with a good signal strength stock on the long side. That means it's bullish trade, bullish trend. So the setup, unlike a lot of things that are bearish trade and trend, I think something like 90% of the S&P 500 is bearish trade and trend. So it's, irrespective of what you've done or thought that you've done looking backwards, fundamentally, this one's looking forward. Long ships, I guess. We're long pot and we're long ships. I didn't think I'd come out of that with that, but we'll keep it there. All right, thanks, Jay. Appreciate it. Now I got. Did you get taller?
I did. I'm like Ron DeSantis. I'm wearing heightening. I can't believe that's all the rage, but it's hilarious.
Does he do that?
That's what the Trump's guys are saying about DeSantis. It's funny. It's like all over Twitter. It's crazy.
That he wears pumps?
Yeah.
I went to school with DeSantis.
Yeah, I know. You say he's a good guy, right?
Yeah, I will absolutely mock him if he's wearing.
Yeah.
Come on,
So
come on.
I guess I don't think he's admitted to it, but apparently it's the hot topic. All right. So Choice Hotels on the short side. CHH. I'll give you the quick pitch, and then we'll run through some slides to back that up. But I don't like the hotel industry. Long term, I like it. I just don't like it right here. And there's really two issues we have. One is more applies to the hotel owners, which is RevPAR is going to continue to be worse than people expect. The other is more to the brand companies. Net unit growth, for a lot of reasons, is not going to materials like the companies expect, like it has historically, and certainly like the street expects. Well, usually that's only relevant to the franchise companies, the brand companies, and the RevPAR issue is more of a problem for the hotel REITs. With Choice, they're both a big problem. Okay, so Choice, they have grown their fees since COVID a lot more than most of the other hotel companies, and RevPAR has been a huge driver, right? So usually when you're looking at a Hilton or a Marriott, you're less concerned with RevPAR because over time recoveries will happen, things will come back. You're more concerned with net unit growth. With Choice, it's been all about RevPAR growth. So what happens when that stops? Well, it's already stopped. RevPAR, not only for the industry, is only up low single digits. That's not massive fee growth, but their chain scales, which have outperformed, punched above their weight, are now in negative territory. So they need net unit growth. Well, that's not happening either. All the problems we see for the industry is way more acute for Choice because they don't have net unit growth. Okay, they have, and let's just hit some slides real quick here. So if you look at the next slide, so we're just showing you that the fee growth has been excessive for Choice, but look at the switch pre-COVID versus post-COVID. Look how reliant they are on RevPAR now. Wow. That's an issue, okay, with RevPAR turning negative probably for the next 3 or 4 quarters at least. Then you go to the RevPAR issue, the next slide. This is our RevPAR tracker, which has been way better than the industry at forecasting RevPAR. We've got decelerating RevPAR barely up. Again, that's for the industry. For their chain scale, it's negative. Okay.
That looks like a bull market chart there, huh?
Yeah, that's right. That's right. And you might say, the fourth quarter, there's an uptick. No, it's calendar rated in October. Now you're back to deceleration. Next slide. Okay, so this is the overall industry issue. This is the rooms in the pipeline compared to the existing base of rooms over time, right? And you can see we're on a downward trajectory now, right? So there's fewer rooms as a percent. It's a law of large numbers. That's going to be an issue. And the chart on the right shows you that these cycles take a long time. So we're going to be stagnant at the very minimum. That's before I layer in the issues on and everybody else has net unit growth going up, right? So that's an issue. Now, if we get specific to Choice, the chart on the right shows you what percentage of rooms are actually under construction, right? So rooms under construction, you've heard me say this, cancellation rate's only 3%. So if it's under construction, it's going to happen, most likely. And if it's in the early planning phase, it's 36%. So you want to have rooms under construction in your pipeline. Choice has the fewest percentage of rooms, as you can see from the chart on the right. That's actually the previous slide, or the next slide, sorry. Good, yeah, the fewest rooms actually under construction out of all the brand companies. That means their pipeline is way more risky. Let's look at their net unit growth on the next slide. You can see it's decidedly negative, and that's with an acquisition that was supposed to power their net unit growth. This is the Radisson acquisition, which they keep talking up as such a great acquisition. Well, everybody looked at the Radisson acquisition, and it's like the winner's curse. They offered the most. That's why they got it. And they've actually had net unit growth go negative from just the Radisson. You can see there on the right, you can see the pre-COVID net unit growth, and the current net unit growth is decidedly negative once again. So then we get into Choice and their specific, our projections. You can see from the chart on the left, we're well below the street on net unit growth for the coming years. That gets factored right into the valuation, right? This is why these companies have big valuations. They have this net unit growth that can grow the company and the business outside of what RevPAR does. And then you go to the last slide, you can see our price target derivation.
I like that. I just popped this in my chat GPT to say what brands do they own.
Yep.
Because I just wanted to sound less.
Yeah, it's all low-end brands, and they're trying to upscale a little bit, but now they're moving into Hilton and Marriott's that's downscaling. They're much better companies, especially Hilton. They're clean their clock.
These are like some of these. This is like hockey tournament hotels.
And they're trying to buy Wyndham, right? Which is they're buying. This is what companies do that can't grow. You've seen it a million times. I don't have organic growth. I'm going to go out and buy somebody.
Interestingly, the market, not surprisingly, punished them for that.
Yeah.
And now the stock is bearish trend. Trend was 125. It went through that like a hot knife through butter. But like, do people actually call you back and say, I disagree with you on this?
We get a pushback on the quality of the business. Well, it's a brand company. We just get fees. It's a low capital intensity. It's a good business. I don't disagree with that. But if you're priced the way you were pre-COVID, same multiple, same elevated multiple, for a business that's not growing and actually is probably shrinking, like does that deserve the same multiple? It deserves some kind of multiple. But the same multiples when you were growing your units 3% and RevPAR growth was positive? No.
And who are these people here on the shareholder list? Barbara, Bruce, Roberta, Stuart. They own a bunch of stock. Bainham's?
That's probably old family
Old
in there. Yep.
Old money. Old money. Okay. We got it. Thank you very
you.
much for staying on time too. That was it's excellent. I mean, when somebody says don't short it because it's a good company, I mean that's ridiculous. Risk manage it at least. We're talking about risk management. We're trying to make short selling great again. It never was great, by the way, to Wall Street. They're just always pumping you stuff. Don't forget, they're trying to sell you stock. We're trying to help you risk manage the stocks. All right, Howard, you've done a fantastic job of that over the years. People can't. Your bullshit factor is very high.
It's part of the training, Keith. It's part of the training. When you listen to conference calls for a length of time, you figure out the bullshit pretty quickly.
So what do you got?
Pretty quickly.
You got you got the rest of the clock. We got 6 minutes.
All right, perfect. So I've got a name that someone's going to sell you stock at the end of the presentation, but I'll get to that in a second. But Kura Sushi. K-R-U-S. But I'm gonna. It's a small cap name, $1 billion market cap. But I'm gonna set the table for a second. So the slide here you're seeing is industry same-store sales trend. Focus your eyes on the left side of the chart and that red line, which is the 2-year stack, which is a fairly steep deceleration, and that will continue to decelerate as we hit into, if you look to the left side of there, the January 23 comparison, where industry sales get much more challenging. And you can see on the right-hand side, traffic has been negative for a while. The next slide is labor inflation. This is important for a second, but labor inflation is not going away. We're back down to the 10-year average. Running 5 to 6%. It's not 10, 11, 12% anymore, but it's 5 to 6%, and it's not going to come down any further from here. So what is Kura Sushi, Keith? I don't know if you ever been to one, but Kura Sushi is a revolving sushi bar. Originated in Japan, expanded in North America. It's known for its handmade sushi presented to diners in a conveyor belt.
So it just goes round and round, and somebody can kind of like put a booger on it or a hair or something?
Whatever. So two things. There's a reason why there is not, and we've talked about this, there's not a salad bar that's been successfully publicly traded, right? And there's a reason why there's not been a buffet chain that's publicly traded. Not that this is a buffet chain, but when your food is sitting there in front of other people, right? I don't know. For me, I would never go to this place.
I don't even want to. I don't want to admit what me and my hockey teammates used to do at the Ponderosa. But hard no.
Exactly. So there you have it. Like, just leave the concept there. Now, I have been told, now we've been short this for a while, and we were shorted into the run-up, right, in the first half of the year. And I've been told by people who are pinging me on Twitter and whatnot that they love to take their kids to this place. So it is a very kid-friendly place because it's entertaining. But I would never go there. But nobody cares what I think. So you can see this is a small chain, very rapidly growing, 20+% unit growth. You can see they're going to have 46 units, or they have 46 units, are going to have 46 units at the end of the third quarter. They're going to jump from 45 units on the next slide in fiscal 23 to 55 units the next year. So again, 20% growth. That's important, and I'll get to that in a section. But what you can see now is, Keith, not inconsistent with the industry, same-store sales have come down from 27% in the fourth quarter, roughly what we're thinking about 3% in the fourth quarter of 22 to 3% in the fourth quarter of 2023. And again, what does that look like in the, for the next couple of quarters into 2024? Probably it's going to go negative. They have never made money, as you can see, or I should say they never made money since fiscal 20. Now the estimates are for a hockey stick improvement, to use your hockey analogy, Keith, in 2024 from a loss of $900,000 to $5.6 million. And note that they lost more money in 2023 than they did in 2022, and sales and same-store sales accelerated, right? So that's a problem. Here's the big problem, Keith. They are going to burn more cash in 2024 to grow those units than they did in 2023.
Ugh.
They did an equity offering in 2023, and guess what? The group on the next slide, which is the sentiment, which is there are 6 sell-side analysts that follow this name, and they love the name, not surprisingly. And sometime in the the second half of 2024, they will be selling you stock because Kura Sushi is going to run out of cash. So that said, it has seen a significant short covering, as you can see on the next slide. It's been short covering of 13%, and then valuation has come down significantly, but it still trades at 40+ times EV/EBITDA and could get cut in half. Now it's come from 100 to 50, but could go easily from 50 to 25.
Well,
and
it's seen a 3 handle multiple times, and it's let me guess, Stevens and Co. is a banker. No? Could they be?
So. I don't know.
I see them on I see them with 12% of the stock. I mean, it's like, these types of things, my oh my. 22% short interest, evidently, even though you have some people who may want to do that with the kids, this guy's got 4 kids and I'm not doing that with my kids. So, I mean, there's a pretty healthy level of short interest here. I mean, so I'm assuming you have some bears that agree with you, no?
Oh yeah, no, definitely. I mean, this is just, this one will be a single digit shot at some point, but
yeah, it's
not tomorrow.
How many times I've done this with Howard Penny, and unfortunately we're out of time with Howard because we can go on and on, but the amount of times that you have a unit growth story that's pumped to you on CNBC or whatever. Another one that he called was Sweet Greens, which was the salad thing. It's just again, it's up to you to have your own bullshit factor. It's up to us to have the analysts, the models, the process. We want you to get away from that old wall as far as you can get, all right? We want you to capitalize on it too, because what they do is going to crush you in the end. What we're doing is helping you risk manage it with both longs. And I'd like to thank my 10 teammates for popping those 10 ideas on the screen and really giving you an education on that. Thanks for joining us.